Hello everyone. This is the second video in the Monopoly series of videos on this YouTube channel. Throughout the course of this video and the next video, we're really going to be diving into how a profit maximizing monopoly chooses output and price. In this video specifically, we're going to introduce the relationship between price and marginal revenue and price and marginal cost for a monopolist and kind of explain how it's a little bit different than the relationship between price and marginal revenue in a perfectly competitive setting. So this video is going to focus on, what marginal revenue means for a monopolist and how that might be different in a, compared to a perfectly competitive firm. In the next video, we're going to specifically derive using, graphical models, what quantity and what price a monopolist chooses to maximize their profits. So let's go ahead and dive into the lecture notes. So this video picks up right where the first video left off, starting with the slide, how a profit maximizing monopoly chooses output and price. So in theory, if you think about it, if a firm is acting like a monopoly, they're the only ones selling a specific good or a service. So you would think that, they should be able to charge whatever price they want, right? Since there's no one competing with them, they can just say, hey, I'm going to charge millions and millions of dollars for this good that I'm selling because there's no one here to undercut me or compete with me to make me or force me to charge a lower price. But, using our models of demand and supply, we can kind of rule out that way of thinking if we consider the fact that the demand curve represents someone's maximum willingness to pay for a good or a service. So even if a monopolist is the only one making a life-saving drug, for example, and they're charging millions and millions of dollars, someone's willingness to pay for that life-saving drug might not be millions and millions of dollars. So monopolists might not be able to sell any of the product that they're making if no one is even willing to pay that much for it. So a monopolist could charge any price for the product, but it is the demand for the firm's product that actually constrains the price from it just being any number that the firm wants. Another key thing to note, which we'll dive into here in a second, is that because the monopolist is the only firm in the market, its demand curve is the same as the market demand curve. What does that mean? Well, hopefully this next slide helps out with that. So if we think back to whenever we started talking about demand and supply, we know that when we draw our demand and supply diagram, that the demand curve is downward sloping. And we assume that, as the price for something goes down, people demand more, so that's why it's a downward sloping line. If we consider the demand for a specific company within this perfectly competitive market, the demand curve for that specific firm is perfectly horizontal. Why is that? Well, thinking back to the characteristics of a perfectly competitive market, we know that there are many, many buyers and sellers of an identical product. So there are hundreds of firms in this perfectly competitive world selling the exact same product. Nothing is different between the type of good that they're selling. So in class, I gave the example of all of the farmers in a specific area selling, the same type of wheat, I think was the example I gave in class. So even though the demand for wheat in general is a downward sloping line, the demand curve for one specific farmer is perfectly horizontal because a competitive firm is a price taker. They have to take the market price determined to sell their product. So if one farmer out of the whole group of hundreds and hundreds of farmers decides to raise their prices just a little bit from what everyone else is selling at, no one is going to buy from them, right? Every other farmer in the neighborhood is selling the exact same wheat. So why would anyone buy from this more expensive farmer? You can also think of it like, because these perfectly competitive firms are selling identical products, these products are perfect substitutes for one another. And we learned when we talked about elasticity that when a good or a service has a lot of close substitutes, people can be really flexible when it comes to price changes. So if one business out of hundreds decides to change their price, everyone knows not to buy from them. Or the demand for that one business is perfectly elastic. Perfectly elastic demand curves are horizontal. So that's just another way of thinking about how the demand curve works for a single firm in a perfectly competitive setting. And that says right here, the firm can increase Q without lowering P, so the marginal revenue is exactly the same as the price for a competitive firm. So because they can't deviate from the price, every additional unit that they sell, that marginal revenue that they bring in from selling one more of this good is the same as the price. A monopoly, however, works a little bit different. So because a monopoly is the only firm in town making this one specific good or service, everyone has to buy from them. There are no close substitutes for what this monopolist is making. So the demand curve for that one specific firm is going to be the exact same as a market demand curve. So a regular downward sloping demand curve, like what we're used to seeing and drawing in our supply and demand diagrams. So naturally, the way that price and marginal revenue work for monopolists is going to be very different than the relationship between price and marginal revenue for a perfectly competitive firm. So for a perfectly competitive firm, the price is exactly equal to the marginal revenue. But for a monopolist, because if they want to sell more of whatever good they're making, they're going to have to lower the price. So the price is going to be different depending on the quantity that they're selling. So the price is not going to be equal to the marginal revenue in the case of a monopoly. Now, to make this a little bit more clear and show the exact graphical relationship between demand and marginal revenue for a monopolist, I've put together a little example for us to go through. So let's just assume that there's only one business in town that sells cappuccinos. And I called it Common Grounds. So Common Grounds is the only seller of cappuccinos in town. This table shows the market demand for cappuccinos. So as you see, as the price of cappuccinos goes up, people demand less of them. So this follows a regular law of demand relationship. And with this example, I asked you to fill in the missing spaces of the table and find the relationship between price and average revenue and between price and marginal revenue. And the relationship between price and marginal revenue is the one that I really want you guys to focus on. So, filling out this table should be relatively straightforward if we remember all of the different definitions that we learned from the last exam and in the previous chapter. So if we were to fill out this table, we know that total revenue is how much money the firm brings in. To find total revenue, we just take the price that the firm is charging times the quantity that they sell. So if the firm doesn't sell anything, they're not going to bring any money in. But if they sell one cappuccino for $4, the total amount of money that they bring in is $4. If they sell two cappuccinos for $3.50, that firm brings in $7, et cetera, et cetera. So you can calculate the total revenue pretty easy if you remember that price times quantity is how you get total revenue. Now, average revenue is very similar to when we were calculating, average total cost, average variable cost, average fixed cost. You can also calculate average revenue. How do you calculate average revenue? Total revenue divided by the quantity. So if we brought in $4 from selling one thing, we know that the average amount of revenue that we brought in from selling stuff was $4. If we brought in $7 from selling two things, the average revenue per item is $3.50. If we brought in $9 and we sold three things, we know that on average we brought in $3 per item. So we can see very quickly that the price that the monopolist charges is exactly equal to the average revenue. And if you think back to the perfect competition slides that we went over in class before the break, this relationship is exactly the same for a perfectly competitive firm. The price is equal to the average revenue. Now, the relationship is a little bit different when we compare the price now to the marginal revenue. So remember, for a perfectly competitive firm, the price was exactly equal to the marginal revenue as well as the average revenue. But in this case, if we go through and calculate the marginal revenue, we see that a different pattern emerges. So let's go through and calculate out this marginal revenue. How do we do that? Marginal revenue is the change in total revenue divided by the change in quantity. So if we go from $0 to bringing in $4 by selling one item, we just have to do 4 divided by 1 to get 4. So moving from selling 0 things to selling one thing brought in a revenue of $4 extra. If we move from selling one thing to selling two things, we move from bringing in $4 to bringing in $7. So moving from one item to two items brought in $3 extra for this monopolist. If we sell one more item, going from 2 to 3, we move from 7 for our total revenue to 9 for our total revenue. So going from 2 to 3 brought in $2 extra in revenue. We can continue this pattern all the way through, and we see that marginal revenue here actually turns out 0 and even negative. We'll come back to this point in a second. But we can quickly see that the relationship between price and marginal revenue for a monopolist is very different than the relationship between price and marginal revenue for a perfectly competitive firm. For that perfect competition, we know that price is exactly equal to marginal revenue, but for a monopoly, the price is going to be bigger than the marginal revenue, or marginal revenue is less than price. However you want to read this inequality, you can read it either way. So marginal revenue less than price, or price greater than marginal revenue. If we graph out the demand curve and the marginal revenue curve for this monopoly, we can see what this relationship looks like with both of these two curves together. So again, remembering what the demand curve actually represents, the demand curve represents people's willingness to pay for a certain good or a service. So this, logically means that we can use the price to represent what the demand curve would be for cappuccinos from this company. So if the quantity is 1, people are willing to pay $4 for a cappuccino, et cetera, et cetera. So the demand curve here is just the price. If we then also graph out the marginal revenue for this monopoly, we see that the marginal revenue is also downward sloping. So as quantity increases, marginal revenue decreases. But we see that the marginal revenue curve lies underneath of the demand curve. So if we were graphing this for perfect competition, we know that the demand curve is going to be exactly the same as the marginal revenue curve. But for a monopoly, they are two different curves. And this is really important to understand and grasp when we move forward in the next video, determining, what quantity and what price the monopoly should set to maximize their profits. So again, the marginal revenue curve lies below the demand curve. And in most cases, you don't really need to know this, but in most cases, it is half the slope as the demand curve. So again, these are just more points to help you solidify where exactly this new marginal revenue curve is coming from and why it's downward sloping and looking the way it does. So in general, for a monopolist, increasing the quantity has two kind of contrasting effects on revenue. So if the monopoly decides to, increase the amount of product that they're selling, that could potentially raise revenue, right? If they sell more items, then they're going to bring in more money. However, there is an opposite effect that comes from the fact that if the monopolist wants to sell more stuff, because the demand curve is downward sloping, they're going to have to lower the price that they charge per unit if they want to sell more units. So this output effect of selling more stuff maybe brings in more revenue. And the price effect, if you sell more stuff, you're going to have to lower the price. These two are kind of pulling at each other to, the monopolist kind of has to find that balance between this output effect and this price effect. And this is kind of why we saw that when this monopoly moved from selling 5 items to selling 6 items, their marginal revenue actually turned negative. They're paying out more money to make this additional cappuccino than the money that they're bringing in by selling that cappuccino. Or we can also say that this price effect, the fact that they had to lower the price so much to sell so many cappuccinos, this price effect was bigger than the fact that, if we sell more stuff, maybe we could bring in more money. So this is why, in some instances, the marginal revenue for a monopoly could actually turn negative. So this is where this video is going to end. And then in the next video, we're going to take this demand curve, this marginal revenue curve, and add the marginal cost curve to that graph so we can kind of understand collectively how a profit maximizing monopolist will choose the correct quantity and price to maximize their profits.